Welcome back to Tesla Daily News Podcast. Today is February 14th, 2026. In the next few minutes, we'll break down the Tesla headlines most likely to move the stock, a new vehicle-to-grid program in Texas, fresh signs of price pressure in Europe, a China competition gut check, and what looks like a strategic pivot away from legacy models and toward higher volume platforms and energy. Story 1. Tesla just flipped the switch on its first vehicle-to-grid program in the United States, starting with Cybertruck owners in Texas. Context: Tesla has been talking for years about turning the fleet into a distributed energy asset. For investors, the question is whether Tesla can turn cars into recurring energy and software revenue, not just one-time vehicle sales. Details: according to reporting citing Tesla's announcement, the program is called Power Share Grid Support. It's launching in select Texas markets, and it pairs Cybertruck with Tesla's PowerShare hardware so owners can send power back to the grid and, importantly, get paid. Impact: if this scales, it's a margin story. Vehicle-to-grid services can create high-margin, utility-style revenue streams that are less cyclical than car demand. Texas is also one of the most attractive proving grounds because the power market is volatile and households already understand the value of backup power. Takeaway: watch for two numbers over the next few quarters: how many eligible vehicles and how many enrolled vehicles. If Tesla reports meaningful adoption, investors could start valuing more of the Tesla fleet like an energy asset, not just a car. Story 2. Tesla is cutting effective pricing in Sweden on Model Y, but calling it a bonus. Context: in Europe, demand sensitivity is high, competition is intense, and Tesla's biggest risk to earnings is auto gross margin compression. Any sign of further incentives can ripple straight into analyst estimates. Details: Swedish coverage says Tesla lowered the Model Y price via what it frames as a bonus. The key point is not the marketing label. It's the reality that Tesla is still using price and incentives to keep volumes moving. Impact: near term, this can help deliveries and stabilize inventory. But the trade-off is straightforward. If incentives spread across more markets, margins come under pressure, and the stock tends to react quickly to that narrative. Takeaway: investors should track whether this bonus expands to other European countries and whether competitors match it. If it stays localized, it may be tactical. If it spreads, it's a signal that Tesla is leaning back into price to defend share. Story 3. Tesla Taiwan says zero tariffs do not automatically mean lower Tesla prices, and it's holding pricing steady for now. Context: when tariffs drop, consumers expect immediate price cuts. If Tesla doesn't cut, it can protect margin, but it also risks losing unit momentum to rivals who pass savings through. Details: multiple Taiwan reports and an industry note say that even with a framework moving towards zero tariffs on US-made vehicles, Tesla Taiwan says there is no immediate price adjustment plan until regulations are clarified and the effective date is confirmed. They also said there's no plan to move production for Germany-imported models. Separately, Tesla reiterated it expects Model S and Model X to be discontinued around the second quarter of 2026, while promising ongoing service, software updates, and support. Impact: the pricing stance is, in the short term, margin protective. But the bigger investor headline is the product strategy embedded in the Taiwan statement. Model S and Model X appear to be heading out. Takeaway: if Model S and Model X exit in the second quarter, watch what Tesla replaces them with in production allocation. The market will interpret this as Tesla focusing factory capacity on higher volume models and future platforms, rather than low-volume halo vehicles. Story 4. The narrative around the end of Model S and likely Model X is getting louder in European media. Context: Model S was iconic, but it's not the profit engine today. Tesla's valuation depends far more on Model 3, Model Y, energy storage growth, autonomy software, and whatever comes next in a lower-cost vehicle and robotaxi. Details: German outlets are framing the end of Model S as the end of an era and asking what it says about Tesla's future. Whether or not you buy the emotional framing, investors should treat this as a signal about SKU simplification. Impact: simplifying the lineup can reduce complexity and cost. But it also removes premium-priced units that can help average selling price. The net effect on financials depends on whether Tesla fills the gap with higher-margin software and energy, or just loses mix. Takeaway: don't over-index on nostalgia. The real question is, does Tesla use the freed capacity and engineering focus to accelerate next-gen manufacturing, improve cost per vehicle, and push higher attach rates for software? Story 5. Xiaomi's EV surge in China is a clear competitive warning sign for Tesla, especially for Model Y. Context: China is Tesla's most competitive major market. It's also where pricing pressure can set the tone for global EV pricing, and where investors watch Tesla's demand health closely. Details. CNBC reports that Xiaomi's YU7 SUV ranked first in China by January sales at 37,869 units, about twice Tesla Model Y's volume for the month. Separate reporting notes Xiaomi has delivered 600,000 cars since April 3, 2024, and is targeting 550,000 units in 2026. Impact. For Tesla, this is about share and pricing power. A domestic consumer electronics brand translating its ecosystem strengths into EV demand pressures Tesla's core crossover segment. If Tesla responds with price cuts, margins suffer. If it doesn't, share can slip. Takeaway. Watch Tesla's China registrations, lead times, and incentive activity. The moment Tesla has to choose between defending volume and defending margin is when Tesla volatility usually spikes. Story 6. China is moving to curb the EV price war by banning below-cost vehicle sales. Context. Investors have been watching a brutal race to the bottom in China. If regulators successfully reduce irrational discounting, it could stabilize industry profitability, including for Tesla's competitors and potentially Tesla itself. Details. Multiple outlets report that China's regulator issued guidelines that prohibit automakers from pricing cars below the cost of production, part of a broader effort to end the prolonged price war after passenger car sales fell sharply year-over-year in January. Impact. If enforced, this could reduce extreme pricing tactics and make competitive dynamics more rational. But there's a catch. Cost can be hard to define and easy to game through incentives, financing, or bundled services. Takeaway. For Tesla shareholders, this is mildly positive if it reduces the most destructive discounting. The key is enforcement and whether pricing simply shifts into non-sticker incentives. Quick market lens before we close. Broader U.S. equities sold off in the latest session, with commentary pointing to anxiety about artificial intelligence impacts and upcoming inflation data. When macro risk-off hits, high-beta names like Tesla often move more than the index, even if Tesla-specific news is neutral. That's it for today. The big themes are clear. Tesla is pushing deeper into energy monetization with vehicle-to-grid in Texas, navigating real price pressure in Europe, and facing sharper China competition right in the Model Y sweet spot, while signaling a cleanup of the product lineup as Model S and Model X approach the end of the road. For tomorrow, watch for any follow-up details on the Texas vehicle-to-grid rollout, any expansion of European incentives, and fresh China data points that hint whether Tesla will defend share with pricing or hold the line on margin. If you found this helpful, subscribe to Tesla Daily News Podcast and follow for a new, investor-focused Tesla Roundup every day.